Ever look at a massive company and just wonder, how do they come up with that giant price tag? Well, it's definitely not a number they just pull out of a hat. Today, we're going to break down exactly how the fascinating and really important world of company valuation actually works.
So, yeah, how do you put a price tag on a whole company? It really is the billion-dollar question that guides CEOs, Wall Street analysts, and investors just like you. It's what's behind every big merger and every major investment decision. So let's dive in and see how it's done.
Okay, first things first. Before we get into any of the numbers, you've got to understand a really critical concept. In finance, value and price are not the same thing. They sound similar, but knowing the difference, well, it changes everything. Think of it like this. Value is what a company should be worth based on a deep analysis of its assets, its earnings, and most importantly, what it's going to do in the future. It's a calculated idea. Price, on the other hand, is just the number that a buyer and seller agree on. It's the handshake deal. And those two numbers can be very, very different. So where do we even start when we're trying to figure out a company's value? Well, a common approach is to take what we can call a static snapshot, basically a look at the company based on its past performance, kind of frozen in a single moment. The simplest of these snapshots is something called book value. It's pretty much what it sounds like. For our example company here, Alpha Inc., you take everything it owns, all its assets, and then you subtract everything it owes, all its liabilities. That number left over, that's its book value. Nice and simple. Another popular snapshot uses what are called multiples. You've probably heard of the most famous one, the price-to-earnings ratio, or PE ratio. It's a quick and dirty way to see how much people are willing to pay for $1 of the company's profits right now. A really high PE usually means investors are betting on some big growth ahead. But here's the big problem with these snapshot methods. They're a bit like trying to drive a car by only looking in the rearview mirror. You get a perfect, crystal clear view of the road you've already been on, but it tells you pretty much nothing about what's coming up ahead.
So what if a company's past isn't the whole story? What if its best days are actually still to come? To capture all of that future potential, we have to move from that static snapshot to something more like a dynamic motion picture that shows us where the company is headed.
And this brings us to what many consider the holy grail of valuation, the discounted cash flow method, or DCF. Here's how it works. First, you try to predict all the cash the business will bring in over, say, the next decade. Then, and this part is key, you discount that future money. Because think about it, a dollar you might get in 5 years isn't as valuable as a dollar in your pocket today, right? There's risk involved. That discounting accounts for that risk. Once you add up all those adjusted future cash flows, you get a much more complete picture of what the company is actually worth right now. Okay, so we have snapshots of the past and motion pictures of the future. Does it really make a difference which one you use? Oh yeah, a huge difference. The final numbers can be worlds apart. Let's just look at Alpha Inc. again. The simple book value method says it's worth $80 million. Using a PE multiple, that jumps way up to $173 million. But when we use a future-focused DCF method, we get a value of $218 million. That's the exact same company, with 3 wildly different valuations. It all just depends on how you look at it. So what are the big takeaways here? First, a company's true value really comes from its ability to make cash in the future, not from what it's already done. Second, that's why many experts see DCF as the correct way to value a company, at least in theory. And third, that doesn't mean the simpler methods are useless. They're still great for a quick look or for comparing similar companies side by side. At the end of the day, it's so important to remember that a valuation isn't a hard science. It's really more of an art. Every single method is just telling a story based on a different set of ideas about the future. And like with any story, some are just a bit more believable than others. The only question is, which story do you believe?